Thank you. Good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for Tortoise Capital for September 9th, 2020. And today was very strongly connected to yesterday's presentation. So I really think there's some value in listening to the opening 15 or 20 minutes from yesterday and then taking a look at the kind of trades that we saw today. And the reason I say that, let me get my drawn pen here. So what we said yesterday was approximately this: that we had seen an exaggerated move up. So we'd seen one strong move up, kind of a flat failure to fail. I'm drawing that as that blue arrow. And then this leg up. And that was really the third leg up. This was the second leg up. It's off the chart, but down here there was a move up, the first leg up that kind of came into the station here and then took off. And then you had the sideways move here. So let me draw that as kind of this blue arrow. And then this price level is kind of where we've come back to, right over here at about 340. So there's a really important symmetry in there. Now, the move that got us to this price level at 340 initially was really excellent. It was like at the upper end of normal. So if you had some kind of normal range, and then you saw, price had moved that far, at the upper end of normal, you wouldn't be surprised to see it move up and then hold, and then recover back to like the midpoint. So that would be a good one leg up and a nice little pullback. Well, what we got instead was kind of just it moved up and flattened out. It did not sell off, and then we got a really steep third leg. This third leg that went from 340 to, let's just call it 360. That's plus $20. $20 on 34 is like another, plus 6% in about 10 days, or even less, because this is really about 8 days. So if you're getting 6% in 8 days, that's like 0.8. About 0.8% per day. I mean, if you could do that for 260 days a year, I mean, you're talking about an annualized 175% per year. So there were a number of reasons to realize that this move up was really extraordinary. It included getting above the Z2 line, so that's the Z2. Here's the Z1. Here's the river, so that's Z0, Z1, and Z2. And this thing culminated in a really powerful move to the upside. So that was extraordinary. And it was unusual to see that when you think about leg 1 and leg 2 and leg 3, you normally expect the first impulse to be strong, this one to be good, and then it kind of petering out here. But instead what you got was leg 1, leg 2 was bigger than leg 1, and leg 3 was really big. So this was abnormal for a number of reasons. This long run of uninterrupted PSAR gains without ever getting interrupted, that was like 35 or 40 days of uninterrupted movement. The slope of the RL30 was long and strong, and this was becoming exceptional. And then the size of the stretch now when we look at the peak, the peak of the RL10 was hit right here. And when we compare that to, well, obviously the stretch away from the Bollinger Band mean, and you can't even see the RL270 is way down here. So the amount of this stretch from the RL10 all the way down to the RL270, this shows the difference of opinion between the traders who are pushing the price way up and the long-term buy and holders, long-term buy and hold, which is for us what the RL270 represents. So when you see that much difference of opinion, this stretch away from the long-term fair value had occurred. It went so far so fast that if you were thinking of this as a rubber band, you would say, oh man, that thing is really stretched. So that's the RLFF, the regression line fractal framework, which compares the RL10 to the RL270. That stretch had gone so far that a pullback would not have been unusual at all. So when you have a range of normal expectations, and then suddenly that thing goes even further into abnormal, well, like we said yesterday, there is a standard work for abnormal conditions is not to go crazy, but to start locking in those rising trailing stops in such a way that you lock in more of the abnormal gains, that you want to make more and more of the abnormal gains yours and give back less and less the further up the stack that goes. So if you go back like for the last week or 10 days, you can actually hear us talking about how as this move was pulling away from the PSAR, which is ordinarily a pretty good, you can see already, we didn't want to give back that much. We were talking about, 1 day lows and halfway up the stack. And so when we actually took that exit, it was up in here. So we only gave back this much and protected against that much. So that's standard work for abnormal times. So then what we said yesterday was this sell-off from this abnormal gains. Then we had an abnormal sell-off that in the space of 3 days, it took like 30 days for this thing to get that high. But then in a matter of 3 days, it sold off from here all the way down to that low, which was more than 7%, not quite 10%, but it got to 7%. And so we were concerned about, man, if this thing falls out of the river, now suddenly we want to have 2 positions, and then that would be the way that we want to go. So we realized this price here was the limit in the range of normal sell-offs, 7% from the swing high. That's not quite 10%, but more than 10% would be abnormal, and that would have been this price down here. So when you have an exaggerated up and then the limit of a normal move down, now suddenly this becomes really crucial. And if you go back and listen to what we said last night, we talked about 2 things. The first thing we said was that from yesterday's close, it wouldn't surprise us if there was a gap about this big in either direction. So it could have opened, very easily as high as this or as low as that, and it would have been within a normal expectation of a gap away from the close. And then what we said was anywhere inside of that normal range of gap, this thing could very easily come back up here and test, the RL10 or the 10-day high or the top of the dragon or the Z1 or even the Bollinger Band mean. So each one of these now became reasonable price targets for any kind of recovery that would look like strong normal pullback, and then that normal pullback brings in all the buyers who are saying, here I have a chance to buy this thing on sale, and my hope is that I'm going to get this piece of excess gain back to the 10-day high. So buyers would come in if they think that's where this is going to go. And so we can play that as leg one of a swing trade. And then here you find out, well, what happens when it comes back and tests that previous 10-day high? Well, the last time it was there, it sold off. But if this is seen as a buy on dip opportunity and this move is strong, well, then you wouldn't be surprised to see leg one now become leg two of the next move up, and hopefully leg three. So all the buyers who come in to buy it at this support level, which is this support level, are thinking, hey, stage one, just recover the excess gains, then play the new breakout, and then all of these entries in this first leg would be front running the breakout. The conservative guy says, well, let me see it get to a new high before I start buying. So all of these guys are taking a little bit more risk and hoping that this thing will just keep going and the buying pressure will come in and then up it goes. And then they hope that that big previous strong trend up is leg one, and then this whole big leg here is leg two on the next higher time frame. So that's what you would see if you were going to get this kind of move. If you were believing it was going to test the 10-day high and then continue another leg up to 380, because this is 360, and this came down to 340. So if you think there's a $20 move here, another $20 move should take that up to 380. And that's why you might be willing to buy in here. So that's the upside. Now, the downside argument is, as you might expect, just the opposite, where those tactical traders are going to come in and say, come on. So the tactical trader says, hey, this leg two and leg three, this was really abnormal. And all it did during this sell-off was come back to what should have been the upper limit of fair value at 340. And they're thinking, oh, this $20 sell-off could very easily be another $20 sell-off that takes it down to 320. So they're going to play for this one. So from this price level here, around 333, you could, we would not be surprised by a leg down that broke through C1, C2, and came all the way down to the 30-day low. That would still be just a tactical trade. And what it would have done was given back all of these excess gains. So when we looked at yesterday's price action, we found that to be a perfect critical state. Come on, erase for me here. Yeah. So we had a nice move up. Came back a measured distance, and now we can call that a critical state. We're ready to go long to test, or ready to go short to come back here and test. And that's where we were right here. So we were looking for, we wouldn't be surprised to see it go here or here. And that gives us a critical state. So then we said, From yesterday's close, a gap open could happen anywhere inside this box. And then the bigger the gap, the stronger the one-day follow-through. And so what we got was a normal size gap to the upside. And what we were looking to do, as you'll recall, is wherever that thing opens, we were looking to put a frog box, or a minimum manageable risk box, I should say. And then we were ready to play a breakout or a breakout, starting with hybrid frog techniques, and then quickly follow that price and get our risk out of there. So in this kind of hybrid frog technique, come on, work with me here. With that hybrid frog technique, what we're looking, yeah, there we go. Thank you. So, if that's exactly where it opens and it takes off and is going up, then our job is to take that risk and as soon as we can, get it to no lose plus dinner for 2, and then pick up the Bollinger Band mean when we can, and then cash this excess, this tactical move to the upside with a manager stop right here. Or at some point, if we were watching the PSAR, we might also pick up a sniper for 1/2 and then a manager for 1/2. But by the same token, if this thing broke out and went down, well, we would want to make our entry short here and then get our risk as soon as we could to no lose plus dinner for 2, and then pick up the Bollinger Band mean as soon as we can, and then cash this excess gain with the discipline of the manager. And then if we saw something like a harsh sell-off like we saw yesterday and then a rebound, we might just cash that here with a sniper for 1/2. And then if it keeps coming up, take the second 1/2 with the manager. And yesterday's case study, and I think it was maybe I think it was DIA, talked us through that particular one. So the point I want to make is that on the daily charts, we identified a critical state, which then gave us reason that this critical state here gave us reason to believe in a strong move in either direction could be possible. And we mapped out a scenario where it could gap up and go up. It could gap up and go down. It could gap down and go up. It could gap down and go down. So you got any one of those possibilities is very strong. And the idea being is that we want to do intraday technique on that, because this is such a critical state. You've got a bunch of buying pressure coming in that's abnormal, and you have a bunch of selling pressure that's abnormal. The buying pressure is saying, look at this strong move, and we want some of this, and it gave us a chance to buy it back here on sale. So that's why this buying pressure comes in abnormally strong. But then the abnormal selling pressure says, this not only was an overreaction, but this 3-day loss was so big, it could generate some more downside. So now all of a sudden, you have abnormal selling pressure and abnormal buying pressure. And who's going to win that? I don't know. Until this abnormal intraday selling and buying pressure is resolved, I'm not prepared to make a swing trade until I see over the next 3 or 4 days who's winning. Is it the buyers or is it the sellers? I don't know. So I'll just wait and see. So my strategy then is to maximize the intraday trade, not carry that risk overnight, and make bank when I can. That is standard work for abnormal times. So when we are in a critical state on daily charts, that makes tomorrow's day trade much more interesting. So it's worth going back to listen to the strategy podcast for September 8th, because that was the opening 20 minutes where we talked about some scenario work. So now I'm ready to say, what did we actually get? Well, what we actually got was, here was the close. It gapped up to here. It bottomed out quick, zoomed to the top, and then sold off gently to about the middle of the day. And where it ends up is at this key price level. The last time it was here, it took off. This time it voted down. And today it reported back up. And it finishes up right around that 340. So we still have a critical state. All it has done is it's kind of oscillated around this very important 340 price level. This time it went up and back. This time it went down and back. And notice that the size of this wave was this big, and the size of this wave was less than that. So the turning points are getting tighter. So you wouldn't be surprised to see this go until it gets really, really tight around 340 with tactical buying and selling, until we saw something like a sideways quiet channel, or hopefully a Z3P, in which case we would then bracket that trade and say, oh, we'll play the breakout or the breakdown. So we're going to watch to see what happens with this volatility. Does it give us dampening waves, or is this going to just go up, down, and then keep expanding dramatically? That would be the case of a clear winner. If instead the market gets uncertain and the political shenanigans, that could cause things to start making it compress inside here. So if we saw that, then price action there would be even less follow through. We might see something like this, here, 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 and then that price range starts compressing. This would be normal because of the election starting to come back and influence, and people not wanting to take large positions to play for big moves until they see the outcome of the elections. So there's an argument that just says this is part of a normal retracement and it gets into sideways chop. If that were the case, then we would say the era of the big uptrend is over. The big downtrend didn't manifest, and all it's doing is settling into a temporary tactical quiet period around 340. That would not be surprising. If that were the case, we would see the Bollinger Band mean in the middle of the river kind of just roll over and stabilize around 340. So we're going to be watching that as it goes ahead. Not saying that it's going to do that, but I know what to do if that's the case, and that is to continue to maximize the intraday trades, because the follow-throughs won't be there for swing trading. So I'm not in a real big hurry in that scenario to get back to swing trading. On the other hand, I do have to be prepared for the possibility, I do want to be prepared for the possibility that this thing is going to be a swing low down here below the dragon. And then if the dragon bellies out here, so if this thing keeps going, this dragon's going to roll over and then continue to roll up. And then that dragon is going to look like this. And up it goes. So if it takes out the peak of the dragon at 350, that's peak dragon right there. And then the peak RL10 up here at about 358. Both of those are checkpoints on the way up. So if this price action, which only got to here, it's looking at the bottom of the dragon, is that going to roll over? In which case we would see down, a lower high. So if that becomes solid resistance, then this becomes a pocket, and now this becomes the collapsing dragon right here. And down it goes. But if instead it can get through this and breaks out of the dragon here, then that dragon will roll over and continue to go up. So we're going to watch how these things unfold. So that's the three scenarios that are kind of always on our mind. And those three scenarios would be this thing rebounds and then kind of stabilizes in here. Or this thing rebounds, finds support and continues up, and then we're buying dips. And then if it breaks above this, then that's really where it's going to go. And then finally, the scenario where this acts as the belly of the dragon acts as resistance. Excuse me, that should be red. This acts as the belly of the dragon acts as resistance, and this thing breaks down, and then we have a collapsing dragon, and we went too short. So you could see the up move, the sideways move, or the big down move. This one, to me, is the most likely because there's a lot of buying pressure that wants to keep things stabilized, the Fed. The second most likely is the sharper sell-off, which is triggered by people trying to preserve more of the outside gains. The least likely, but still there's some probability, is all systems go and up we go. What could do that? Vaccine? I'm not sure what else figures that. Unless Biden's health suddenly gets bad and the election is tipped to Trump, and then that would trigger a relief rally, and up it goes. Don't wish that on anybody, though. So those are the three scenarios: the big up, the sideways chop, or the big down. And I think the probabilities are 1, 2, and 3. All three of them are tradable. And what we'll be doing is watching to see day by day which one of these becomes, the actual. Okay. So that's what I want to say about this price action. It just looks to me like this 340 price level is really kind of crucial. So I wanted to say all that simply now to take a look at the tactical price levels now. So we are sitting at right at a 5% sell-off from that peak price, that 10-day high and a 30-day high. We're right here at a 5% sell-off. This was that 7% sell-off, which was the 10-day low. And then the 10% would have been this, this move, which takes us from the 10 and the 30-day high. This would have been the 10% sell-off that takes us all the way to Z2, and which brings us all the way back to this price level 30 days ago, which is almost 11% now. Okay. Our 10-day range from 358 3/4 all the way down here to 333. That is a 7.3% sell-off, or range, I should say. And again, that happened all in 3 days. And then today was half of yesterday's range. There was a gap up, and it pushed, but it could not make a new daily high. It got capped at yesterday's resistance level. And so that's why this was really just a one-day tactical rebound. And you can see there was no overnight conviction based on how much was given back going into the close. And so we're right at the Bollinger Band mean, which is the argument for why everybody's sort of agreeing that 340 seems to be a fair value to hold this thing overnight. There was not much evidence of harsh sell-off. So if anything, this is a slight positive for the day because it finished above the Bollinger Band mean and had for most of the day was pushing near the high. But tactically, it could not get above yesterday's high at 342.7. So that's going to act as resistance for tomorrow. Now, if it can penetrate that tomorrow, then it's got to get through the skin of the dragon, the spine of the dragon plus C1, and then the upper skin of the dragon at 350. That would really be a decisive move. And then after the upper skin of the dragon, you're looking at the next up is the hump of the RL10 and the Z2 line, and that would be a complete negation of that 7% sell-off. I think that's less likely than the sideways chop or a I think the more likely case is not this, but kind of grinding over towards 340 or even coming down to test 333. Now, if tomorrow we get this sell-off, I'm tactical until it breaks below the 10-day low, and then that's where I want to have two positions short as it breaks down even further. Then the target is the peak fair value back here, 326, the Z2 line at 322, and then that's the 10% sell-off line. And it's about 11% to the 30-day low all the way back at 319 and some change. So interesting times tomorrow. I'm not sad at all for not having swing trades on. I'm perfectly content to take advantage of the intraday. So hopefully that's what I want to say about market conditions. And I spend more time on that because right now it's the market condition and short-term psychology that's more important than any of the fundamentals for individual companies. Hopefully that will you guys found that to be helpful. Okay, so next up we're going to look at the sectors. So we had the S&P was up 2% today. The Dow was up 1.6 and the Russell was up 1.5. So this was more towards the security and safety of the large caps and the broad market than it was tactical short-term trading. So this was a conservative kind of a gain today. Treasuries was our other U.S. index, and that was down a fraction, still above 163. So of the things that were better than the market, let's look at the sectors first. So we had Mexico, market was 2%, Mexico 2.3, oil 2.5, materials 2.6, Brazil 2.9, tech 3.25, the FANGs 3.6, clean energy 4.3, wheat and precious 5.7, and then Tesla, after yesterday's 21% sell-off or whatever it was, rebounded half of that, plus 11%. And then among the techs, it was a toss-up between the broad tech sector at 9.3 and the triple Qs at 8.6. Now here you can see all of the large cap lovelies that make up the FANG. You get Twitter 3.6, Amazon 3.8, Safe Search, or I can never remember their name. The new add to the Dow, Salesforce, yeah, up 3.8. Apple 4%, Microsoft 4.3, Nvidia chip winner 6.7, and then Tesla, the proxy for unbounded optimism and speculation, up 11%. In the green, but slightly worse than the S&P, was discretionary 1.9, Virgin Galactic 1.8, healthcare 1.7, silver 1.7, Google 1.6. Okay, so now of the things that were worse than the S&P, so the S&P plus 2%, the sectors, emerging markets 1.5, oil exploration 1%, finance 1%, energy 0.7, Japan 0.35, and now getting into the negatives, treasuries minus a quarter, commercial real estate, Simon Property minus 1.7, the VIX minus 5. Now, Nikola was up 40% yesterday and gave back 15% today. So again, not for the faint of heart. Some individual companies noteworthy for underperformance besides Nikola. So part of that whole XLB series, the materials, you got the metals of U.S. Steel, Alcoa, Cliff, and Nucor were all on the downside of the broad market and material sector. Cisco, Goldman, Boeing, Devon, all in the red. So again, still plenty to choose from. I still think what we got to have is the very liquid sectors and getting the market direction right, and then maximizing the opportunity for the intraday trade to make some bank. I still think it's too early to think about the swing trades. I want to shift to the daily report, get that knocked out. Then I have 2 or 3 trading case studies from today to work on. But I want to get the folks that want the prep materials done. I'm going to get them addressed first. Okay, so we've already seen the daily market health check, perfectly positioned as a critical state. We remain in bullish normal conditions. Oops, I'm on the rectangle, not the arrow. So bullish normal. We are only overbought now on the very long term. The 90-day look back has come back into high average, as has the 30, slightly above average. And then we came out of the red now on the 3 and the 10-day look back. So we're in the low end of normal. A little bit, a 1 day of recovery. You can see that reflected here. We are still in the winter on the risk Z. We're down about 10% above the 200-day moving average, so we're still bullish. The ADX has decayed a little bit to 36. It used to be up around 44, but it's still a strong bull trend until proven otherwise. This is now double the volatility that was in play, a week to 10 days ago. It's up to 1.68%. Risk Z just moved into abnormal riskiness. So if you weren't sure that this was a critical state and large moves in either direction with no swing signaling yet, then that should tell you. All of the signals from yesterday for like the overreaction and the channeling did pretty well. And then we still have the U.S. indexes of the S&P, techs, and mid caps still firing on the overreaction long side. The 10-day max pain or min pains are the ones that are closest to their 10-day high. The max pains are the ones that are still sold off the most. So I think Microsoft and Apple to me look like the screaming opportunities. XOP is always good just for a trading perspective, and then the volatility in oil makes the whole energy sector interesting for short-term trading as well. Good to see Devin on our list too as a Max Payne. That just makes him a great intraday trade as well. Only a handful of dojis today. A couple overreaction long signals. That's Microsoft, which was a % winner today, and 2.4 to 1. And you can see that he was up 4% today compared to the peer group in the Dow. So that's good. The other, and he's 2.4 to 1. That's pretty cool. CRM, that Salesforce is interesting. It is a doji. A Max Payne range compression, 2.9 to 1. It was a % winner today. It was up 3.8%. So it's not unusual to see things that sell off on the 10-day then have a nice short-term rebound. So you're seeing that in Apple today. You saw that with Microsoft, and also Salesforce. So Caterpillar was the other one that I really want to draw your attention to. So Caterpillar, if you go back and listen to the strategy yesterday, Caterpillar was the anomaly in the Dow in that it was the only thing that made any money. It was up like 0.25%, while everything else went out and got slaughtered. Well, when you have something that was that strong in the face of all that selling pressure, and then the market turns around and goes up today, it's not unusual then to see what was strong yesterday during time of crisis turns in a really good performance and makes a breakout on all of the NDXs. So Caterpillar, it doesn't have any other tactical signals, but I'll tell you, just on the basis of that read alone, Caterpillar was probably the lowest risk trade today. That once the market started working, Caterpillar was the easiest one to believe in because it had strength yesterday when the market was selling off. So that's some artful judgment there. Okay. Walgreens continues just to suffer on every possible way. In the tactical summary, there's a ton of things that fired on the auto framer. Only 4 dojis. Lots of 551Ws, as you would expect. These are all the ones that have been strong over 5 weeks, gave back over the last 5 days, and then had a positive day today. I would be looking for the tech leaders are the easiest ones to believe in, especially those FANGs. Brazil was actually not bad. It was hard to trade it intraday, but it netted out pretty well for the day. So the Qs or the techs are fine, and energy is a source of weakness. Here's Caterpillar again, the only thing that is a real standout to the upside. Cisco continues to underperform, the only thing out of the river on the downside. Cliff and GE starting to pinch pretty nicely, so there may be a super pinch or a Z3 pinch forming on those guys. Everything you want in the auto framer is right there. So you got Apple and oil exploration, you got energy and oil, you got Goldman, mid caps and silver. There's even some gold in there. There's the techs. So anytime you see that many quality symbols on the auto framer, that's really a market condition. So you need to get the market call correct, and then these other sectors and companies will fill in properly. Even the S&P frames out well on the auto framer. That's actually a healthy sign. On the daily squeezes, these in the top 4, that's nice. You got gold, silver, Goldman Sachs, and Brazil. So you've got some hybrid frog champions in there that are ready to become big one-day moves. You could use something as wide as their daily range for your risk box and use that relaxed approach and get a big move. So I would not be surprised to see a big move on those guys tomorrow. The fall is dominating. Only XLB is in the summer. And then these symbols in the Dow that are in the summer those are all key winners. And so notice how strong Caterpillar, Walmart, Disney, McDonald's. I mean, that's your great American companies anymore, shopping cheap and eating burgers. All right. Only Walgreens suffered today. Home Depot had a nice recovery, great American company, and Nike had a recovery. Silver with a recovery, gold with a recovery. Defensive plays the Euro Asias and Europe. So while Nero fiddles here in Washington, the rest of the world's starting to shape up. So the 3 harsh days down and then a nice recovery day. All right, that's everything I wanted to cover on the daily. Just want to take a quick look at some trade frames from today. Okay, so the first one up, I'm looking at Caterpillar here. So this was the opening back here. Here it is at 9:45. You see the Z3, or I'm sorry, this was 3:45. So this was yesterday's close down here. Let me draw the vertical blue line so we get the framing in here correct. Okay, so there's yesterday's close. And what I've done is I've taken the minimum manageable risk box, and cloned it. That's from the Z3 to Z3 during the idling. And then for 10 minutes into this thing, I'm going to straddle the VWAP, because all we've done is made a noise channel all day. So this is how wide the channel is when it's just grinding, and that's all it did here. And so I'm going to straddle the VWAP. And now let me zoom in a little bit and see how I can frame this. So let's, I'm going to ask you to commit to your trading strategy. Given that right in the middle of a sideways quiet channel, failure to fail further. This is Caterpillar. Yesterday was it made money while everything else got slaughtered. So you got to think to yourself, would you get long at 1 or 2 or 3, or short at 4 or 5 or 6? And then if this is your minimum manageable risk box over here, that's your minimum manageable risk box, and I'm straddling that. Maybe if I wanted to bracket 1 and 4, I might even make that smaller and say, you know what? I'm ready to play the breakout from, if on the PSAR, a break above the PSAR. This one, number 2, is a breakout above the Z2, and this would be a Z3 breakout. This would be getting short at a break of the Bollinger Band mean, Z1 and Z2. So what I've done is just basically built a Z-score ladder. All right. So go ahead and commit to that. As usual, I like the 1 and 4, and I'm going to pick up whatever the midpoint of that is going to be my. I'm going to use the VWAP as my initial stop. Whichever way it breaks, I'm going to go in that direction and then use the VWAP as the blocker, as my resistance. So it's either going to be that or it's going to be that. Okay. Bingo, bango. So I'm going to take the entry here at 1 on the PSAR breakout. And going to play my stop like right here. I got to make that smaller, too big. I like a second entry as soon as I can. Now, at this point, the PSAR has not moved above my entry yet, but on such a decisive move, you can see I've already here's the PSAR, and now the Bollinger Band mean are going to kind of continue up this way. Where I need to be at no lose plus dinner for 2 would be to do a sniper exit right now and probably bring it up to like right here. That would lock both of those entries in, and I would have, some gains. If you wanted to give it more room, your break-even point is probably like right here, but that just feels like I'd be giving up, that much from the swing high. I don't want to give back that much. So for me, this is a time to engage a sniper and like just move him up to about here. I think that feels about right. And then once this piece, once that PSAR and the Bollinger Band mean catch up, then I can raise that stop. And meanwhile, that just locks in my gains. Now it's a science project. So now at this point, I'm probably ready to do this. Get like a 1 bar low. So I'm going to move that up to there. And then I'll leave that in place, never lowering it until either the Bollinger Band mean or the PSAR catches up to me. Now, it's an optional thing to me whether at this price you added a third position. That's almost pretty early, but you could consider that one or this breakout here. Either one of those could be a third position. I'm just going to play this with 2. So at this point, you might have you if you were playing the 1 bar low, then you probably would have gotten that exit. The reason to play that would be if you had looked at this, you had 1, 2, 3, 4 bars closed outside of the Z2. You've locked in 2 really good gains on a relatively small risk. And so a 1 bar low would get you out right here. This one hasn't quite hit the stop yet. We'll see if it does. It probably does. It did not. Oh boy, hooray. Now it made a new high. It took out so this new high, and now we're back up. We teased just north of Z2. but didn't quite close above. But we're really pushing that higher. So so if this was our stop, I'd probably want to be like right about there now. And that way I've locked in this excess gain right here, which feels like it's about the size of one of my risk boxes. Yeah. So I just locked in another unit of risk. And that one would have gotten me out. Oops. Now, if that gets you out, you then got to say, would this get me back? A breakout above here get me back in? I don't know. Not worth. I mean, it's worth thinking about, worth giving it a try. Depends what else is going on in the market. So, just as a quick total, we would have this as a gain. This one as a gain. So that's our stacked gains, if you will, on an initial risk of this much. So that's like 1, 2, 3, probably 4, 5, 6 execution Rs in Caterpillar, which in my view was the lowest risk trade of the day. And the reason to be interested in those re-entries, like getting re-entering right back here, that's a continuation of the previous one. Now, I want you to notice, if we just are using the Wu Wei exit, notice how that rascal keeps you in for that whole move, and even the sniper with the PSAR keeps you in that whole time. This may or may not have gotten you out. And then if you just let the Wu Wei exit do what it does, look how much better that one is. And then if you take the PSAR exit, you're here. So there's a lot of good reasons to just let the Wu Wei exit be what it is. You can be as active as you want in here, and I wouldn't discourage you from that, but I would just say there's a certain utility in the Wu Wei exit and the PSAR. That ain't bad. And then this exit, using the Wu Wei, you get that increase and that increase on half the positions. So, and never really threatened. So that's Caterpillar, the lowest risk trade of the day, because yesterday it made money when the market got slaughtered. And then the market starts working today, so Caterpillar does pretty well. And this is, you got to be able to recognize this as a critical state based on the size of the Z3 minimum manageable risk box. It never broke out of that. And now you have a low and a higher low. You have the spring turn to summer and then a breakout above the dragon. Bingo. Second one. And up we go. And then the Wu Wei exit protects you all the way up. And that's without even trying to optimize additional entries. Here is Mexico. So here is the size of the manageable wrist box. And what I'm noticing here is the VWAP. We are one wrist box or more above the VWAP, and it's starting to roll over. So I'm stalking this thing. Now here, it has come all the way back to the VWAP. And I want you to think of this as, it opened here, sold off, rebounded leg one, sideways, leg two, and came all the way back. So now it's right here at the VWAP. So if I take the minimum manageable wrist box and just straddle this rascal, I now have something like this. And why is this nice? Well, Mexico's been weaker than the S&P, been one of the weaker sectors altogether. And this was yesterday's close down here. So a rebound down to this level gets it back to the opening, and then a sell-off of that magnitude, a second one, brings it down most of the way to yesterday's VWAP and close. Here's yesterday's VWAP. So there's two scoops of movement. Here was the one scoop. So now I'm going to play. I'm going to now vector this in. So if I could go, let's call it. The Z1, or I'm sorry, Z2, Z3, and maybe we'll call it the right here at the RL270. I'm going to shrink up my MMRB here a little bit. On the upside, if it breaks back above the Bollinger Band mean, I like that. This one, if it goes back above the peak of the dragon, and this one peak RL10. I'll get rid of that. Clean this up a little bit. Okay, so let's lock in your choices for trades. Here's 1, 2, 3, 4, 5, 6. One wrist box. So I'm just going to split that wrist box in two, something like that. Okay. So go ahead and lock in your choices. I'm going to do the 1-4 split again, and I'm going to use that VWAP as my guide. And I'll be ready to play that in either direction. The breakout of either of that yellow box. Okay? And we're short. And short a second one. All right, so now we are about, we are 1, 2, 3 PSAR dots below our first entry. So I can think about this now. And lock in my stop right there. Now, what I notice is this new collapse, the fact that the high of the bar was there and it closed so weakly, I could be tempted to just lock in like the skin of the dragon. And now my second entry is locked in. So I think I'm going to try that. Let's see how that works. So I'm going to advance my sniper a little bit. And now here's my Bollinger Band mean. And then this would be my, that PSAR extension looks something like that. So this is the typical geometric approach to managing stops that I'm thinking about. So I'd like you to think about which stop makes sense to you. Using number 4, where I just am going to use the PSAR, or 5, where I'm going to lock in my sniper and just keep him in place until I make my next adjustment, or 6, I just want to be content with the Wu Wei exit and using the Bollinger Band mean. So commit to that right now. PSAR, adjusted sniper is number 5, or the Bollinger Band mean is number 6. And then you got to decide also, if at 7 you wanted to add a third position short. So good, lock in your choices. There we are. Now, if you were with me, then you got exited right there. If you were the Bollinger Band mean, you're still right there. So let's play this forward a little bit. So this would be the screaming re-entry right here, because even though you got hit, the RL10 rolled over and gave you another RLXD. So I'm short 1 from there. And I will use the PSAR as my stop. All other things remain in effect. Now, notice that the Bollinger Band mean is still keeping you in. And here's what the slope of that thing looks like now. So that's looking pretty good. Typical second exit there at 7, where we programmed that before, which was all the way back over here by the low of the day. So that low of the day now is why you get short another one here. And if you're using the PSAR, you're kind of right there, and the Bollinger Band mean is like right there. So Bollinger Band mean stop would be at that yellow dot. The PSAR exit would be here. With 2 positions in, you could even argue why you might want to have your stop here at 4. So I'll let you pick. 4 is the close one. 5 is you're committing to the PSAR. And 6, you're committing to the Bollinger Band mean. Okay? Make a decision. If you were at 4, you end up giving back is it blue? Yeah, that's blue. Give back this much. If you were using the PSAR exit, oh, sorry, you actually get out right there. So the PSAR exit would have gotten you out here. The Bollinger Band mean, number 6, gets you out there. This number 4, I'm going to be fair and say, look, if you had seen that spike all the way down, you probably would have gotten this to here. So I'll give you that for 4. So you make money on that second round, but notice that the the Bollinger Band mean exit gets you out here. So the PSAR feels pretty good on that. So both of those trade sequences make money. And at 6 or 5, at 5 or 6, you have either a supported spring crossing and you make this money. Using the Bollinger Band mean, you get that trade. And using the Wu Wei exit, you end up exiting up in here. So the supported spring crossing kata gets you this trade from here to there. And all you did was come back and find the previous the previous VWAP was right here. And it recovered from the excursion down. Now you can see that triangle. And notice how symmetrical that is. So you just see a lot of that kind of symmetry, the magnitudes of moves. So you can always use those as ways to calibrate the not surprising next leg. Okay? So that's what I want to say about that. All right, we're at 9:20. That's everything I wanted to cover. The other 2 trades were just kind of more of the same. Wheat and precious metals, I'm not going to go through that one that much, but Wheaton was a very orderly move up on that defensive play. This was the minimum manageable risk box. If you play that off the low, you end up getting this trade. And the Wu Wei exit probably gets you out like right here. So on an initial risk of probably 50 cents, you end up making $1. So a very relaxed couple R right there. And with the opportunity for a continuation right there, which you'll not lose any money on that one. Okay. The final one I just wanted to show was Microsoft. So I wanted to show Microsoft on a 5-minute chart because sometimes people find that easier. It's less. So we're on a 5-minute. So this was the open, this blue line, and yesterday's sell-off took it all the way down here. But then you'll notice this was the size of the risk box from Z3 to Z3, and then that's the size of this risk box. So I put that on the new VWAP, straddle it, and I set up this frame. I notice that the RL90 has bottomed out, and if that thing just continues on that same slope, it should gain like this. And then I'm noticing this is the horizontal line of the VWAP. So if this thing can break above the green line, then it's voting north of the VWAP, and then my bet is that it would stay north of the VWAP. So that would be my basic trade. And here's my risk box then. And then if I'm just using 5-minute charts, you get 3 entries pretty quick. You get one clear breakout from Z2 or Z3, and then another breakout from the previous Z3. So you get 1, 2, 3, and it's feeling like this now. And there's some reasonable gains. If you are playing the Wu Wei exit, just like you're supposed to, you get that exit. The third position is kind of always problematic to me. I sort of I trust the first two. The third one, I got to have a really good reason to do it. If I was on 5-minute charts, I don't know I would add a third position. But if you had put that one in, I wouldn't be surprised if that one got you out. But then if you do, you got to get back in, and now you get this. You get the second trade, re-entry, key to sanity, tight stop at the PSAR, Wu Wei exit, or even a sniper exit. Okay, so 5-minute charts, also possible to work on these if you find the 1 minute or the 3 minute too quick and you want to increase your span of control. The 5-minute chart is a reasonable way to approach it. Okay. All right, that's everything I want to cover. I'll get this thing processed and posted, and we will see you in the chat room tomorrow.